Check, mic check.
Mic check.
Welcome to Making Sense of Wealth with Andrew Whalen, your personal CFO. The show where we break down complex financial topics and market events into investor-friendly concepts so that you can make better informed decisions about your financial future. Because if it don't make dollars, it don't make sense.
Welcome to Making Sense of Wealth, everybody. It's been a long time since we've been here, but we're finally in the new building. We've got a new studio to shoot this on, and we couldn't be more excited. It is the end of May. I am joined by Carl, our portfolio manager, and May is Mental Health Awareness Month. And we're going to put a little bit of spin on mental health awareness by talking about behavioral finance. But before we get into that, I did want to take a second and talk about some of the recent events that have transpired, including the shooting at the church in California, the shooting in Buffalo, New York, and just recently the shooting in the elementary school in Texas. Carl, something's got to get done about all this stuff. The people in power have to make some changes, and our hearts and prayers go out to everybody that's involved.
I know, it feels like we've been having these kinds of conversations for years, better part of the last decade since the Sandy Hook shooting in Connecticut. Hopefully our lawmakers finally get it done.
I completely agree. So, Mental Health Awareness Month, we're going to talk about a little bit of behavioral biases that investors tend to face, especially in volatile times. But before we get into the behavioral finance aspect of today's discussion on making sense of wealth, let's talk about how did we get here over the last 5 or 6 months? What caused us to be in the position that we're in the markets? What did the government do? What did the Fed do? What has the economy done to really put us in this boat that we're kind of sailing in right now, which is a lot of choppy waters?
It's been a challenging, unique period the last 5 to 6 months. And really, it's been confusing to a lot of people, including professionals. But that's one thing about financial markets and the stock market in particular that non-professionals and professionals agree on, that from time to time, there's a lot of crazy market action, and we've definitely seen more than our fair share of it the last 6 months.
Yeah, you can say that.
No question. And it really all started with the extreme stimulus and, by the federal government, and then the quantitative easing by the Federal Reserve in response to the COVID pandemic 2 years ago. And they really wanted to err on the side of doing too much rather than too little. That's why the economy grew so slowly coming out of the financial crisis in 2008, 2009, and it took years just to get things back to where they were before that happened. So They didn't want to make that mistake again. So it turned out they overdid it a little bit. They took the bold step of doing a lot of stimulus where they not just affected asset prices, but they put a lot of money into the hands of individual consumers.
Sure.
So what did those people do? They went out and spent it. And not only that, but being locked up at home, isolated, people looked to financial markets as a gambling outlet.
So things like Robinhood.
Right. So there were a lot of people who opened new accounts. It wasn't just Robinhood, but it was all the traditional online brokers that you've heard of and that even we use too. There were a lot of new Schwab accounts. So people did a lot of that. There was a lot of speculation in meme stocks, cryptocurrencies, and associated assets like non-fungible tokens.
Well, yeah, to NFTs, we had pictures of apes selling for $500,000.
Right, and other things too.
You start to question these things, and when you have a lot of this massive liquidity, like you were saying, gets pumped into the system, not only does it cycle, which increases what's known as the money supply, but these people then start to buy financial assets as well as real estate assets, as well as refinancing their mortgages to now redo their homes. And that puts money in the pockets of contractors and refrigerator makers and TV makers. And all of that, it creates inflation.
Well, right. Well, it's also that's really what's called the wealth effect. When you do things to stimulate financial markets, in the economy, everybody feels wealthier. They see their accounts go up in value, and then they spend more than they otherwise would.
Maybe
and then
irrational decisions?
Sure. Plenty of that. There's a lot of emotion wrapped up in all of this. Bull markets are psychological just in the way that bear markets and recessions are too. So we knew that things were kind of frothy last year. But we knew that we were still early in the business cycle. We knew there were signs that this business cycle wouldn't last as long, but we still don't think we're in a recession yet. But what happened, what was a surprise about all of this was that while there were frothy conditions and bubble-like conditions in a lot of risky assets, particularly the higher growth areas of the market, the thing that was surprising about it all was that bubble started to pop right when the Fed started to talk about taking quantitative easing away.
Yeah, you think of it like a drug addict, right? That's been taking a lot of drugs for a long period of time in high doses. And then they take those drugs away immediately. What happens? They go into almost instant withdrawal. So you can think about the massive amount of stimulus that has been pumped into this economy like a drug that was shaking this economy and moving it forward. And then all of a sudden, the Fed starts to say, hey, we need to slow down and start to take away some of that. And that's when you started to see some of these cracks.
Right. So we expected a correction like there often has been in the past when quantitative easing has been taken away or quantitative tightening has been started. But what was surprising here was that we didn't just get a correction. We got a deep correction for the whole market overall when you look at, say, the S&P 500. But we got more than that for the NASDAQ, down about 30%. That's a full-on bear market. But then the riskier part of it was a complete crash.
Right.
You've had a lot of stocks there that are down over 50%, some 70, 80, 90%. And I think in some cases that's fair.
Sure.
But for companies that maybe had a big tailwind from the pandemic, and now maybe those sales are going to slow down a lot or maybe disappear. But the truth is that there are a lot of great businesses in there that are now trading at very reasonable valuations.
I agree.
In relation to their growth, just like the rest of the market. And they seem like they're being thrown away. But there's a lot of pessimism out there. So that's what we're dealing with right now. And I think we just have to be patient with and work through. And
an overabundance of stimulus and then taking that stimulus away has really put us in the position where we're at today.
Right.
Yeah.
So it's surprising, but we still think we're still early in this business cycle based on where we are with respect to the Fed raising the Fed funds rate, with regard to decreasing the size of the balance sheet. We're nowhere near flattening, inverting the yield curve, which is a key part of ending business cycles. And even over the last week, banks have come out saying that they're doing great, raising their guidance for net interest margin on loans. So it's hard to get a recession when banks are pretty healthy.
Right.
You can have certain areas of the economy maybe, dialing back a little bit from all of the changes in the pandemic consumption patterns. And we're seeing some of that and hiring freezes and some layoffs,
especially
in
the
some
big
places.
tech companies.
But I don't think that's really indicative of a recession. It feels a lot to me like the 2015 to 16 period where we had too much oil drilling, fracking, and then companies were cutting back a lot there.
So that's kind of how we've gotten to where we are now. Before we talk about what we think is going to happen for the rest of the year, again, I said it was Mental Health Awareness Month, and I wanted to talk about some behavioral finance biases that kind of get some investors in trouble. So we picked out about 5 of our favorite ones that we tend to see, especially with some retail clients. The first one being overconfidence bias. Now, I'll start with that one. And overconfidence bias basically talks about the fact where most people think that they can predict what the market's going to do, or they know how to time the market. And I know there was a survey that talked about, I think about 75% of professional investors say that they're above average investors. The other 25% said that they were just average. So no one is a below average investor. And that gets back to the overconfidence. And what happens when people become overconfident when they're investing?
Well, they don't risk manage properly. I think the best example of overconfidence is when someone thinks that this particular security or this stock is going to be a winner, and I'm going to put most of my money into it. I know it's going to do well.
Right.
And that's something that a lot of people do when they're really new to this. They haven't had enough experience to know that risk management and position sizing is really the most important thing, because you want to do well over time, but you want to make sure that you don't blow yourself up.
Yes.
The best way to blow yourself up is to be really confident in something and then just happen to be wrong. Or maybe you aren't really wrong. Maybe just the sentiment changes and things just go crazy like they have recently.
Melvin Capital, which is the hedge fund that blew up and is officially shutting down, is a perfect example of overconfidence, where they saw an opportunity, made the position sizing a little bit too large, and then Wall Street bets came out of the woods and basically shut the hedge fund down. So that's number one, overconfidence. We see it all the time. Number two is confirmation bias. And confirmation bias really starts to talk about the fact that you have a preordained feeling that you're trying to do some kind of research on, and you're looking for outlets that confirm what you already think is true. And why that gets people in pickles is because they don't look at all the different sources, right? So they may have a particular confirmation bias about what they think this stock is going to do, and they only look for sources to confirm that particular bias.
Right. Everyone is a victim of this at different times. Clients, the influence that they have on professionals, the environment that you're in. When you're in a raging bull market, everyone looks for reasons as to why things could get better. They're not looking at what could go wrong. And then likewise, when you get into a deep correction or a bear market, nobody can see the light of day. They're always looking.
Or you see a stock that has nothing but buy ratings, and you really like this stock because of the product or the service that it's selling. So now you're reading on all the news channels and all the news outlets, all the good things about that stock, and then that confirms you to go and buy that individual
Or
stock.
somebody doesn't understand something. They have an opinion that they've either consciously crafted in their head, or it's just subconscious and they don't even really realize it. And they look for only facts and information that support their viewpoint. They don't look at all of the data and try to take an objective view of everything. And it's a very difficult thing. It's a very important bias to be aware of. Everyone's a victim of it at different times. And I think the best way to manage it is to be aware of it and try to look at all the information in the most holistic, unbiased way that you can.
Or work with someone that can help you do that.
Right.
Ideally. Now, the third one, it's one of my favorite ones because I have conversations, and I'll use an example for it, which is anchoring bias, right? And it's when you try to anchor something that's happened in the past to something that's going to happen to the future. That's one way to look at it. And my easiest example is if we're going through reviews with clients during this year and the big R word comes up, which is recession, everybody's mind always anchors towards the great financial crisis or the dot-com bubble. And what they don't really reflect on is the amount of recessions or mild recessions that we've had, but their mind automatically gravitates towards that previous anchoring. Now, you had a different example, I think, right, of anchoring bias, or no?
Well, anchoring is just any time when somebody looks at past information and fixates on it or anchors on it, and they don't think about whether it's relevant today or it's true today, and they don't consider whether their view toward it should be revised, and it's old information. So yeah, like a good example is when somebody gets hurt or burned by something in the past, and then they never want to go near it again in the future. And that's an emotional response. It's kind of an evolutionary one.
Yeah.
But it's also why you have the behavior that you have in markets, and it'll never change because there's so much emotion, and when you start raising the possibility of certain things that people are really afraid of and fearful of, it kind of snowballs.
Sure.
It's why, like, when you think of how much the total value of the stock market goes up and down, and you look at that over time versus how much GDP goes up and down, we're typically growing GDP at a real rate of a low single-digit percentage. When we get into a recession, typically it doesn't really go down that much. It goes down like maybe a few percent if it was a deep recession. If it's a shallow one, it might even be less than that.
I just see it with clients a lot.
But the value of assets out there in the world swings wildly.
Yeah.
I mean, we're talking about like 20% decline for like a big correction, or like a bear market that's recessionary being like 30 to 40% or more. But GDP doesn't go down that much.
Sure. And I think that gets back to the point of behavioral finance is emotional cycles are a lot shorter than market cycles, right? And that's one of our biggest jobs is trying to navigate those emotional cycles to help clients avoid not only the biases, but working with those biases that they have and trying to break them free to help them avoid making mistakes in the future. So number 4 is one we see all the time. It's loss aversion bias, right? And there was a Nobel Prize winning economist and psychologist. His name was Daniel Kahneman. And he came out and he found out that the pain of a loss is 2 times the joy that someone gets from a gain. And what loss aversion bias really goes into is the findings that if someone's been burned once, they start to think that that's going to happen and their stomach starts to twinge at any sight of volatility. And what do? They run for safety. Right. Maybe sell at the most inopportune time or the bottom of the market because they just can't take the pain. Or maybe a statement comes in and they say, okay, get me out of everything, even though I'm not going to make anything in cash, just as an example. Right. So anything you wanted to add on loss aversion?
It's why risky assets like stocks take the stairway up, or the elevator, or the escalator, right. Or sometimes the window.
The window down. Sure. Yeah. No, that's
because
exactly
fear
right.
is a lot more powerful than greed, and you can see that in the market. Bull markets are a slow process. They don't take big jumps up. They grind higher, and corrections in bear markets are more volatile and take big steps down quickly. Sure. Because fear is a lot more powerful than greed.
Now, you added the 5th one, and I think this 5th bias for behavioral finance is probably the most relevant for last year and maybe even 2020. So what is that 5th bias that's related to behavioral finance?
Herd behavior bias.
Okay, so tell me what that is.
That's when people don't really behave like rational thinking people or animals. They behave more like irrational animals. Mm-hmm. And they all do things like a herd of animals.
Right.
And they don't think about it. And everybody is vulnerable to this, like all the way up to the most knowledgeable professionals. It's when it happens when you see somebody doing something and doing well because of it. And if you're not doing it too, you feel left out.
You mean like buying cryptocurrencies or meme stocks?
Right.
Just as an example. And
or if somebody flipped an NFT and made $50,000 or $100,000 and I didn't participate in that, I might feel stupid and left out for a while. If I hear enough of my friends doing that sort of a thing, I might feel like, what have I done my whole life?
Right. Or
at a point,
you continuously see mom and pops making, millions of dollars on YouTube through real estate flipping. And you say, wait a minute, why am I not flipping real estate? So the same applies to that asset class as much as it does to stocks.
Right. So this is how you can get big movements in markets and overbought or oversold conditions. It applies on the way down as well as on the way up. And professionals are vulnerable to this too. There have been notable cases in the past where so many good investors and people running big successful funds went into the same kinds of companies that had disastrous accounting problems because they didn't look at all the details themselves, but all their friends were buying it. And they never heard the end of it when they went to cocktail parties and conferences.
I've got one example of this. So this happened. This could have been, and everything's more clear in hindsight, but this definitely could have been one of the signs where you said, why are we investing, right? And like I said, it's always clear in hindsight. But there was a fund manager that was on CNBC, and he was getting interviewed for some of his most recent picks. And he named off Upstart. And he said, well, we bought it at X number of dollars. It's up 30% in 6 days. It's probably a little bit, outdoing itself. And the anchor, interrupts him. He says, sir, what is Upstart? I've never heard of that one. What is Upstart? And the gentleman completely broke down. He had no idea what the stock did. He bought it based off of herd mentality. And he just basically said, I'm having an audio problem right now. We're going to have to cut to a different segment. And then, since then, Upstart's down like 90%.
Yeah, right. I can't hear you. What? Keep asking me?
Yeah.
I don't hear that.
Yeah, exactly. Yeah.
Speak louder.
So I think that was a really great example. So FOMO is another way of putting out, herd mentality bias. But, there's a lot of biases when it comes to behavioral finance. We wanted to touch on our 5 most that we see either on a yearly basis or an annual basis, or what we see through other investors, because controlling some of these biases and avoiding them really helps with the long-term rates of return of a portfolio. And we have a mantra at our firm: focus on risk first versus return. And that's one way we try to, control some of those behavioral finance biases.
Right. Well, the key thing with a good investment process is the risk management. You want to survive and make sure that you try to put yourself in a position when this crazy emotional activity happens in markets, that you can, at the margin, profit from it instead of be victimized by it or feel like you have to react and protect yourself from it. Because really, a lot of this stuff is irrational on the way up and on the way down. And if you're in a position where there's always something that you can do to, at the margin, incrementally profit from what's going on, that's a characteristic of a good process.
Sure. Yeah, it's all about the process. So, okay, we talked a little bit about what got us into the year that we're in right now. Overstimulus, Fed taking the juice away from the party, aggressively having to raise interest rates to combat inflation that was caused by a massive amount of liquidity that was being pumped into the system. We touched on some of the behavioral finance topics that relate to investing mental health. So we took a little spin on that. What I want to do before we close out is kind of talk about what we see over the next 6 months. And clearly, neither one of us are Nostradamus, but we have an ability from the tools and the research that we perform and what we tell clients to kind of talk about what we're seeing over the next 6 to 12 months from a market standpoint, from an economic standpoint. What are the likely probabilities of some outcomes?
Well, let's finish up and talk about like where exactly we are right now. So what's going on now? We're in a deep correction. We're having a bounce right now because things got kind of oversold the last month. Inflation is elevated. It's a problem. The Fed is moving to address it.
Not just elevated, it's high.
A lot of people think it's too slow and it's not enough and it's too little, too late. And that's probably right. The Russian-Ukraine war has really made it difficult on energy and agricultural commodity prices. Whatever the outcome is there, we don't expect that to go away anytime soon.
But if it did, that would have a huge play on the global economy.
Right. It would definitely reduce inflation a lot.
But a low probability of something like that.
So the blunt instrument way that the Fed has of fighting inflation, given that they can't address the supply chain issues or anything going on with disruption from the Russian-Ukraine war, all they can do is raise rates, raise the Fed funds rate, and implement quantitative tightening, slow the economy down. So with this deep correction that we've had, a lot has already happened there. We expect inflation to come down gradually. I don't think anybody really knows how much it will come down by the end of the year or what the exact reaction in the bond market will be to, if it continues to come down, but it still is elevated, what that means. But we've done a lot of work on that where we've looked and we've discussed debt levels in the past and how that's a big issue. The interest expense in the federal government's going to go up a lot, maybe 30% or so this year.
So that kind of puts a cap on how high rates can go is kind of our philosophy.
It puts a cap on rates. It also, hurts their ability to spend and refinance treasuries. They're going to, with the interest expense going up, they just won't have as much money to spend. And the same thing is going on across the whole economy right now. Private sector, housing market, we see the housing market slowing down a lot right now. So
the difference between 265 and 5.5 is almost double the mortgage payment.
Right.
Let alone the house has gone up 20%
right,
in the last
over
year.
the last couple of years for the same kind of house, you're now having to pay twice as much for the mortgage.
So that'll naturally slow that. So as the Fed starts to work through and get some rate hikes in, it's going to naturally contract the economy, much like we've already started to see. It's just going to take a few quarters for kind of some of those other things to really bear fruit.
Right. So we still we think we're in a mid-cycle slowdown because of that, because the banks are still doing well, and there are some key structural differences in the economy between now and the 1970s, which we could go into as to why we don't think we're going to have runaway inflation. But the big thing is that when you think about how much debt was taken on to do all the COVID stimulus measures,
I was hoping you would bring this up.
Yeah, I mean, what it all comes back to is that the fact that we started it 4 years ago, we were around 80% debt to GDP. Now we're 120%. So we went up 40.
I just hit 121.
We went up 40% and climbing.
Right. Yeah.
If you look at the federal
122 now,
the federal debt clock, it's going up every day,
every second.
With all of that, you could say, well, if this was all the inflation that they could generate, it has to go on for the next 4 years for us to break even on the amount of debt that we created to generate it. And the only way you can really keep that going is if the tax collections can go up with inflation and the wages can go up, and because that's the biggest part of tax collections.
Yeah, what's shocking to me is the amount of money that we've spent. I think what was the stat? It was for every dollar that's been created, 40% of all dollars created in U.S. history have been created in the last 2 years.
Right, the money supply went up 40%.
So we created that much stimulus and we're only able to generate 8% inflation.
Right. So ultimately, if inflation settles down from now, whatever the rate it happens to be, because we created so much debt, it's ultimately going to be a deflationary thing.
Yeah, deflationary. Yeah, sure. And it's not including the ramifications of technology on deflation. But a little bit more choppiness, probably be looking to, sell the balances, reposition to be a little bit more conservative, because from everything that we've been looking at, we've been fairly confident that we're going to have a recession in the next 12 months. And like I said, to get back to anchoring bias, that doesn't necessarily mean that it's going to be a great financial crisis. We lived through there was the period of the 1970s where they were also combating inflation, and we had milder recessions at that time where you didn't have unemployment go up to 10%. You didn't have massive layoffs and massive bankruptcies or housing collapses or things like that, right?
Right. So we expect a choppy environment going forward, and we don't expect any new highs in the equity market until inflation slows down enough that the Fed can slow down on the rate hikes and the quantitative tightening, because that's a huge headwind, and they're doing a lot to fight inflation.
So think back to 2018. The Fed wasn't aggressively raising rates as much as they are now, but they were raising rates. You had a lot of volatility. Into December, they raised rates again. That's when you got the really big sell-off. They probably went a little bit too far. And then they started cutting rates.
And that's what people call the dovish pivot.
The dovish pivot. And then from 19 till March of 2020, the market's ripped.
Right. But the interesting thing about that period was that stocks, long-term bonds, gold, and gold miners, they all performed about the same over that period of time, coming out of late 2018 and into early 2020.
Yeah, so being diversified is important as well.
So you can be diversified to lower your risk in that way. We think that's a smart thing.
Well, here's how I know everything's gotten a little bit crazy. Is you look at a company like Google. great company, strong economic moat around it from a product, service, intellectual property standpoint. And it's growing at about 15, 20% top line a year. And it's trading at the same valuation to growth as a company like a Clorox or a Kellogg. Those companies are only growing sales by about 1 or 2, maybe 3% in an abnormal year because it's just keeping pace with new births, right? Only so many people will be added to the line to buy more Kellogg cereal or use Clorox wipes. And that's why I find it really crazy that there are a lot of opportunities now, but the last thing that you want to be doing is aggressively buying those things if we are going to continue to see some choppiness and maybe get a little bit lower valuation. But when you start to see those things, if you've got a longer term outlook of 3, 5, 10, 15 years, I think we're getting pretty close to some good entry opportunities, which I think we're going to be taking advantage of over the next 6 months.
Right, absolutely. There are a lot of companies that are undervalued, being thrown away, and as long as the economy stays strong enough that their sales and earnings don't go down a lot, as long as we're not in a recession, they should be doing just fine. And if they're able to buy back a lot of shares, that should put a floor under a lot of the recent action that's been going on. And we've seen that lately. Companies that are doing well, profitable, buying back shares, they've held up much better than the ones that aren't able to do that.
Well, how'd you like your first episode of Making Sense of Wealth?
I liked it a lot. I like being under the neon lights here.
Yeah, well, it's the Neon City. So, all right, we'll wrap up there. Everybody, thanks for joining us today. Official first Making Sense of Wealth in the brand new office. It's every single month that we do this. In between, we do weekly Sense, so make sure you check that out. You can follow us on all social media channels. You can watch this video online. Make sure to comment or share with anyone that you know, and we'll talk to you next month. Really appreciate it. Thanks.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.